Bitcoin dropped below $90,000. Why does this number matter? 2025 was the year retail investors collectively lost over $10 billion to 5 predictable mistakes. Meanwhile, pension funds returned over 8%, hedge funds profited from volatility, and institutional portfolios outperformed by double digits. Same markets, different system. I spent 20 years in the institutional side, and here's what they did different. Before we dive into the mistakes, let me give you the context. 2025 was defined by 3 massive market events. First, the April Liberation Day crash, where $6 trillion evaporated into 48 hours. Second, the AI dominance debate, with the Magnificent Seven controlling nearly 40% of the S&P 500. And third, the Bitcoin roller coaster, from all-time highs to underwater in weeks. Each of these events created a clear divergence. Retail investors made emotional decisions. Institutions executed systemic strategies. Let's break down exactly what happened. I'm going to show you 5 specific mistakes that cost retail investors billions. More importantly, I'll show you the institutional counter strategy for each one. No theory, just what actually worked in 2025. Before we start, a quick disclaimer. I'm sharing institutional framework and market analysis based on historical data. This is strictly for educational purpose and does not constitute personal investment advice. Let's hit it. Mistake number 1. FOMO buying at the peak of the AI hype. This was systemic across millions of retail portfolios. Now, to be clear, I'm not calling AI a fake bubble. The technology is real, the revolution is real, but paying any price for a great asset is still a bad strategy. Here's the reality. The Magnificent Seven, Apple, Microsoft, Nvidia, and the rest, they generated 3/4 of all market gains since late 2022. Combined market value over $21 trillion. This is extreme concentration. Nvidia became the poster child. Retail investors piled in at the absolute peak. When Nvidia dropped in November, it dragged down the entire tech sector. Investors who bought at the top lost 20 to 30% in weeks. But here's the institutional perspective. Research firm didn't bet against AI. They simply flagged the valuation as overheated. They saw the prices were priced for perfection, leaving no room for error. So what did institutions do? They didn't panic sell because they hated tech. They simply rebalanced. When tech stocks grew too large in their portfolios, they trimmed their positions. No emotions, just rules. If a single stock makes up more than 10% of the portfolio, sell the excess. In early 2025, smart money rotated profits into defensive sectors. They kept their AI exposure, but they managed the risk. Mistake number 2. The Bitcoin timing disaster. This one hurts to watch. Because I'm a strong Bitcoin proponent myself. Long-term, Bitcoin is a pristine asset, but short-term, November 2025 was a brutal reality check. Bitcoin dropped below $90,000. Why does this number matter? Because that's the average price most ETF investors paid. For the first time, the average investor was underwater. Here's the timeline. Bitcoin hit an all-time high in October, over $126,000. Trump in office, everyone expected crypto-friendly lows. Retail investors flooded into Bitcoin ETFs at the very top. Then reality hit. By November, prices crashed. We saw over $3 billion leave the market in a single month. The Fear and Greed Index dropped to extreme fear. Retail investors panic sold after losing money for weeks. And this is the mistake. Treating a long-term store value like a short-term slot machine. This connects directly to mistakes number 4, which we'll cover in a minute. If you try to trade Bitcoin based on hype, you lose. Institutional strategy was different. They view Bitcoin as an asset class, not a lottery ticket. Hedge funds reduced their exposure by almost 1/3 when Bitcoin was above 120,000. They have a simple rule. Take profits when everyone is euphoric and accumulate when everyone is scared. When retail panic sold in November, institutional buyers quietly started buying again. They understand the long-term value, so they use the volatility to their advantage. In that exact week, my dad texted me, "Hey, I'm planning to buy more Bitcoin. What do you think?" And my reaction was, yes, that's exactly the right instinct, because it was right before Black Friday and a high-quality asset was suddenly trading at a massive discount. Mistake number 3. Panic selling during the April crash. This was the biggest market shock of 2025. Let me remind you of the timeline. April 2nd. The announcement of the Liberation Day tariffs. Massive taxes on imports. The market hated it. $6 trillion in value vanished in 2 days. The Nasdaq dropped 14%. It was the biggest global sell-off since COVID. Now, look at the reaction. Institutions moved fast, initially to reduce risk, but then they stopped. They waited. Retail investors, many panicked at the absolute bottom. They sold their stocks after the drop, locking in a huge loss. And here's the strategy. The market recovered. Those who sold in panic missed the bounce back. Then they bought back when the prices were high again. This sell low and buy high behavior destroys returns. Institutions stayed disciplined. They didn't sell into the panic. They waited for the dust to settle and then bought cheap assets from the fearful sellers. Mistake number 4. And this one is so human, so emotional, so irrational. Overtrading and using too much leverage. This isn't about one event. It's about bad habits that drain your account. Let's look at the data. Retail investors are terrible with leverage trading. Germany's financial authority released a study on retail traders using leveraged products. The results were shocking. Nearly 75% of private traders lost money. The average loss was over 6,000 euros per person. Total retail losses were in the billions, and it gets even worse. If you traded frequently, more than 1,000 times, your chance of losing money jumped over 90%. 9 out of 10 frequent traders failed. And please keep this number in your mind. The shining day trader influencers out there, they are an absurd small minority. If you want to be a day trader, all odds are against you, and you won't get rich quick. Back to statistics. The problem wasn't the market. It was treating the stock market like a casino. Retail investors used leverage to gamble. Institutions use leverage differently. They use it to protect their portfolio, not to gamble on direction. And most importantly, they don't overtrade. They have a plan and they stick to it. Excessive trading just creates fees and taxes, no profits. Mistake number 5. Fake diversification. This connects back to the AI discussion. In 2025, the big tech giants made up almost 40% of the S&P 500. If you bought a standard index fund, you thought you were diversified, but you weren't. You were heavily betting on just 7 companies. Many retail portfolios had 60 or 70% of their money in tech stocks. When tech corrected, their entire wealth took a hit. We saw people buying companies with 0 earnings just because they had an AI story. No fundamentals, just hype. The institutional approach is true diversification. Family offices in 2025 spread their money across different asset classes: stocks, bonds, crypto, real estate, private credit. Pension funds kept strict limits. If one sector gets too big, they sell some of it and buy something else. The goal isn't to get rich quick, it's to not get poor. And that strategy worked. Pension funds hit their targets while retail investors chased their tails. Let's recap. 5 mistakes, billions in losses, FOMO buying at peaks, bad timing on Bitcoin, panic selling in April, gambling with leverage, and having too many eggs in one basket. The common thread? Emotion over system. Retail investors reacted to news, institutions executed a plan. Here's the secret. It's not about being smarter, it's about having rules and discipline to follow through. Systemic rebalancing, predefined risk limits, strict diversification, long-term horizon. They don't try to predict the future, they prepare for it. When volatility spikes, they follow the rulebook, not their gut feeling. You don't need a hedge fund to do this. Set your limits, rebalance once a quarter. Don't put more than 50% in one sector. When you feel the fear of missing out, wait. When you feel the panic, do nothing. Detach and observe. This is the way. If you found this useful, leave a comment. Which mistake do you think will be the biggest trap in 2026? Is AI still overheated? Or something new on the horizon? I read every comment. Subscribe for institutional grade insights. No hype, just systems. Speaking of systems, next video we are going to destroy the concepts of New Year resolutions. Studies show they are garbage and destined to fail. I will show the data on why they don't work. And I will show you the anti-resolution framework that actually delivers results. Thanks for watching. Check out the video on the screen and remember, boring systems beat exciting emotions.